For 5,000 years, money has traveled farther than the people who trusted it. Silver mined at Potosi paid a war debt in Madrid. A promise inked on paper in 11th century Sichuan settled accounts in a city its writer never saw. That is the slow, patient, mostly reliable story of money-moving trust across distance and time. At the same time, in every one of those 5,000 years, someone has looked at the gap between a promise and the proof behind it. The space where trust runs a little ahead of what is actually sitting in the vault, and quietly decided to spend the difference. Mansa Musa gave away so much gold on a single pilgrimage that he emptied a market without meaning to. A single tulip bulb once outpriced a house on an Amsterdam canal. A Boston immigrant named Charles Ponzi turned one real idea into a fake one so thoroughly that every scheme built the same way still carries his name. This channel does not tell you what to do with your money. It watches instead at what money has already done to everyone who held it before you. Built, borrowed, debased, cornered, forged, and lost across some of history's plainest and strangest financial disasters, taken calmly, roughly in the order they happened. One of them, quietly, still shapes a habit almost everyone listening already has, without knowing where it came from. Let us begin where the story of money almost always begins, with someone certain they had found the one exception to it. In the winter of 1637, in Amsterdam, a single tulip bulb named Semper Augustus changed hands for a sum that would have bought a fine house on one of the city's canals. The buyer did not think of himself as a fool. He believed he had found the safest investment in the Dutch Republic. The tulip had arrived in the Netherlands by way of the Ottoman court only a few decades earlier, and Dutch growers quickly discovered that a virus, though they did not know it as one, could split a bulb's color into the streaked flame petals that collectors prized above all others. Because an infected bulb produced few offsets, the finest patterns stayed genuinely rare, and rarity among people with new fortunes from overseas trade and nothing yet fashionable to spend it on became its own kind of fever. Buyers and sellers met in tavern back rooms, trading promissory notes for bulbs still sitting in the ground, unseen, sometimes changing hands 10 times before a single one was ever dug up. Notarial records from that final winter show prices for the rarest bulbs reaching sums that a skilled craftsman could not have earned in several years of steady work. The popular version of this story, repeated for 3 centuries, holds that all of Dutch society, from merchants down to chimney sweeps, gambled away its savings on flowers, and that the whole economy buckled when the market finally broke in February. The historian Angolgar, working through the surviving contracts and estate inventories, found something narrower and stranger. A fairly small circle of well-off merchants and specialist growers driving most of the trade, few recorded ruins, and a moral panic, stoked by pamphlets written after the fact to scold Dutch greed that grew far larger than the archive can support. What is not in dispute is the handful of documented sales themselves, numbers so extreme that no exaggeration was really needed. When the market did finally collapse in February, Dutch courts largely declined to enforce the defaulted contracts at all, treating the trade more as a gambling debt than genuine commerce, which let a great many buyers simply walk away from obligations that legend insists ruined them. The bulbs went back to being flowers. When the ruler of Mali entered Cairo in the summer of 1324, on his way to Mecca, he brought with him a retinue said to number in the thousands, and enough gold that he simply gave it away, to the poor, to scholars, to anyone who asked, for the weeks he stayed in the city. Mansa Musa ruled an empire that controlled much of West Africa's gold production at a time when gold from that region supplied a striking share of the entire medieval world's supply of the metal. His wealth was not exaggeration or rumor. Cairo's merchants and money changers watched it arrive in caravan after caravan, and Arab chroniclers of the period, including al-Umari, recorded the visit within a generation of it happening. What they also recorded was the aftermath. So much gold moved through Cairo's markets in so short a time that the metal's local price fell and stayed depressed for years afterward, an effect modern economic historians can still trace through contemporary price records. Money changers who had built their businesses on a stable price for gold found their margins gutted by a foreign king's generosity. Some accounts suggest Mansa Musa himself later tried, on his way home, to borrow gold back from Cairo's lenders at punishing rates, in an attempt to help restore the balance he had upset, though how much of that detail is legend, rather than record, is harder to say with confidence. What makes the story worth telling is not simply the size of the fortune, though it was immense, but the shape of the disaster it caused. Nobody stole anything. Nobody defaulted on a debt. A market simply could not absorb an act of pure generosity at that scale without breaking under it. A reminder that abundance, delivered too quickly, unsettles an economy in much the same way scarcity does. Word of his wealth spread so far that European mapmakers took notice. A Catalan atlas produced barely 50 years later depicts a West African king holding a golden orb, among the earliest European depictions of the region at all. No one in Cairo ever saw gold quite the same way again. Isaac Newton sold his shares in the South Sea Company in the spring of 1720, pocketed a tidy profit, and told a friend he could no longer stomach watching the market's madness from the sidelines. Then he bought back in, near the top, and lost a sum historians commonly place near £20,000 when the whole scheme collapsed that autumn. The South Sea Company had been granted a monopoly on British trade with Spanish America, a market that, in practice, barely existed for a British firm to profit from. Its real business turned out to be financial engineering. The company offered to absorb a large portion of Britain's national debt in exchange for government bonds paying fixed interest, then sold its own shares to the public on the promise of trading profits that were, at best, speculative. As the share price began to climb through the summer of 1720, driven less by any underlying business than by the simple fact that it was climbing, the company's stock rose roughly sevenfold in a matter of months. Members of Parliament, courtiers, and ordinary investors who had never owned a share of anything piled in. When confidence finally broke in September, the fall was just as fast, and it took much of the rest of the London financial world down with it. Newton's reversal has become the story's enduring detail, precisely because it undercuts the comfortable idea that financial panics only catch the naive. He was, by any measure, one of the most disciplined minds Europe had produced. A line often attributed to him afterward, that he could calculate the motions of the heavens, but not the madness of people, is genuinely stirring, though the earliest record of it comes second-hand, decades later, and its authenticity is far from settled. Whether or not he said it, the pattern it describes held. Remarkably, that very same year saw a strikingly similar collapse across the Channel in France, where John Law's Mississippi Company failed for closely related reasons, a coincidence later economic historians have found too striking to treat as mere chance. Newton, for his part, kept his post at the Royal Mint regardless, and went on managing England's actual coinage for years afterward. His calculations, for once, were beside the point. A denarius minted under the Emperor Augustus was, by weight, almost pure silver. A denarius minted 200 years later, under the emperors of the 3rd century crisis, was mostly copper, with a thin silver wash, and it still had the same face value stamped upon it. No single Roman ever announced this change. It happened one small reduction at a time. An emperor here trimming the silver content by a few percent to stretch a military payroll. An emperor there doing the same to cover the cost of a building program or a war that had run long. Each individual step was modest enough that a merchant in the marketplace or a soldier receiving his pay had little reason to notice it against the coins he already carried. Only across generations did the cumulative effect become impossible to miss. Prices for ordinary goods climbed, and the coin itself grew visibly duller and lighter as its precious metal content thinned. By the reign of Gallienus in the mid-3rd century, the denarius contained only a small fraction of the silver it had once held, and the Roman state, tellingly, had to introduce new denominations and constant reissues just to keep commerce functioning at all. What makes the denarius' slow decline more instructive than a sudden crash is exactly its gradualness. A currency does not need to collapse in an afternoon to fail. It can simply be worn away, coin by coin, reform by reform, until the thing people are holding no longer resembles the thing they once trusted. Economic historians still cite Rome's long debasement as one of the clearest ancient illustrations of what happens when a state treats its currency as a resource to be quietly spent rather than a promise to be kept. A particularly telling example arrived under the Emperor Caracalla, who introduced a new coin called the Antoninianus, officially valued at 2 denarii, though containing barely more silver than a single one. A debasement so transparent that modern numismatists still cite it as a textbook case of a government quietly inflating its own currency by decree. The coins kept their faces, only the silver left. On a single morning in October 1307, agents of the French crown moved simultaneously against every Templar house in the kingdom, arresting the knights before word could travel between towns. The Knights Templar had begun 2 centuries earlier as an order sworn to protect pilgrims traveling to the Holy Land. But protection is a business that touches money, and over time the order became something close to an international bank. At its height, it controlled a network of several thousand properties spread across Europe, from castles and farms to the preceptories that served as its financial branches. A pilgrim could deposit funds at a Templar preceptory in Paris and withdraw the equivalent in Jerusalem, carrying only a sealed letter of credit rather than a purse of coin through bandit country, a system of branches and paperwork that would not look entirely unfamiliar to a modern banker. Kings borrowed from the order too, and by the early 14th century, King Philip IV of France owed the Templars a substantial sum, the legacy of wars against England and Flanders that had drained his own treasury. Philip was also conveniently in a position to erase that debt entirely. Charges of heresy and blasphemy were brought against the order. Confessions were extracted under torture, and the Templars were suppressed across Christendom within a few years, their French holdings absorbed into the crown or redirected, after considerable delay and dispute, to the rival Hospitaller order. The order's last Grand Master, Jacques de Molay, was executed some years later, still protesting the order's innocence to the end. Historians still debate how much of the heresy case was genuine conviction and how much was simple convenience, but the financial mechanics are not in serious dispute. A debtor with an army moved against a creditor who had none, and the debt, along with the order that held it, ceased to exist. Many of the financial techniques the Templars had pioneered, the letters of credit and long-distance transfers chief among them, did not disappear with the order itself, and were picked up and refined in the following century by the merchant banking houses of Italy. The debts, in the end, were the easiest part to forget. 2 of the largest banks in Europe did not fail because of a bad harvest or a falling price. They failed because a king stopped paying his bills. In the 1330s and 1340s, the Bardi and Peruzzi banking houses of Florence were among the wealthiest financial institutions on the continent, with branches stretching from London to the eastern Mediterranean. Both had extended enormous loans to King Edward III of England to help finance the opening campaigns of what would become the 100 Years' War against France. Loans secured against future customs revenue from English wool, the country's most valuable export. War, however, is expensive in ways that outrun even careful planning, and Edward's campaigns cost more and returned less than either the king or his bankers had expected. By the mid-1340s, he simply stopped paying. The sums involved were so large relative to the bank's total capital that neither house could absorb the loss. Both collapsed within a few years, and the failure rippled outward through Florence itself, since much of the money the Bardi and Peruzzi had lent to Edward belonged in turn to Florentine depositors, merchants, and even smaller savers who had trusted their city's great banking families with their savings. The contemporary Florentine chronicler Giovanni Villani, himself among those who lost money in the collapse, wrote of the shock rippling through families who had thought their deposits as safe as the city walls. The episode is often cited by financial historians as one of the earliest clear illustrations of sovereign risk, the particular danger of lending to a borrower who cannot easily be sued or forced into court, and it took Florence's banking families the better part of a generation to rebuild the trust the collapse had cost them. Smaller houses that had lent more cautiously, spreading their risk across many minor borrowers instead of one crown, survived the same years largely intact. Villani himself put a staggering figure on the debt in his chronicle: though modern historians treat his precise number with some caution, more confident in the scale of the disaster than in its exact arithmetic. A king's word, it turned out, was not itself collateral. It is easy to assume that finding a mountain of silver would make a kingdom rich. Spain found several, and spent the following century discovering otherwise. The richest of these discoveries came at Potosi, high in the Andes of what is now Bolivia, where a mountain of nearly pure silver ore was found in 1545. Over the following decades, ships loaded with New World silver crossed the Atlantic to Seville in vast and growing quantities, and from there the metal spread outward to the rest of Europe, paying for Spanish wars, Spanish debts, and Spanish imports. More silver chasing roughly the same quantity of goods and land did what economists would later recognize as a basic monetary pattern. Prices across the continent rose, gradually but persistently, for the better part of the century, a stretch that historians and economists now call the price revolution. The 20th century economist Earl Hamilton was among the first to trace the connection carefully through Spanish archival price records, though later scholars have argued that population growth across Europe over the same period also pushed prices upward, and that silver alone cannot explain the whole pattern. The effect fell unevenly in any case. Wages for ordinary laborers tended to lag behind rising prices for food and rent, quietly eroding the purchasing power of people who had no silver of their own, while landowners and financiers who could renegotiate contracts and rents kept closer pace with the change. Spain itself, holding the source of all this new wealth, did not grow steadily richer from it. Much of the silver was already spoken for before it even reached Seville, pledged against loans from Genoese and German bankers who had financed the crown's wars in advance. And economists studying resource-rich nations centuries later would recognize the same pattern: sudden mineral wealth absorbed by debt and war rather than lasting investment, translating into surprisingly little durable prosperity. Other European governments, watching their own coinage struggle to compete with the flood of new silver, responded with debasements of their own, a defensive reflex that only added further inflationary pressure onto a pattern already well underway. Spain held the mountain and still went broke. In the marketplaces of the Roman Empire in the year 301, a new stone tablet appeared, carved with a list of maximum prices for thousands of goods and services, from wheat to lion skins to a day's labor, and the penalty for charging more was death. The Emperor Diocletian had inherited a currency badly weakened by decades of debasement under earlier rulers, and with it, an empire where prices for ordinary goods had been climbing for a generation. Rather than reform the coinage directly, his edict on maximum prices attempted to solve the problem by decree, fixing what merchants, laborers, and landlords were legally permitted to charge for their goods and services across the empire, with a reach so granular that it set separate wage ceilings for schoolteachers, farm laborers, and lawyers arguing a case. Some historians read the edict as more than a purely economic measure, an attempt by an emperor rebuilding order after decades of civil war and invasion to project firm authority over every corner of daily life, prices included. The logic had a certain appeal on its own terms. If prices were the problem, prices could simply be capped. In practice, the edict ran into a difficulty that no amount of imperial authority could overcome. When the legal price for a good was lower than what it actually cost a merchant to produce or transport it, the rational response was not to sell at a loss, but to stop selling openly at all. The Christian writer Lactantius, a contemporary critic of Diocletian, recorded that goods vanished from the markets rather than change hands at the mandated price. Pushed instead into black market trading, the edict could never fully police. Within a few years, the edict had effectively lapsed, unenforced, and widely ignored, though the underlying inflation that had prompted it continued largely unaddressed. It would take another emperor, Constantine, introducing a new and far more stable gold coin called the solidus decades later, to finally achieve through sound currency what Diocletian's price edict had failed to achieve through decree. The prices held on stone, the goods did not. For 3 generations, the Medici Bank functioned as something close to the treasury of Renaissance Italy, financing popes, wool merchants, and the Medici family's own rise from bankers to rulers of Florence. Giovanni di Bicci de' Medici founded the bank on careful, almost dull principles. Diversify across a network of semi-independent branches, avoid overexposure to any single borrower, and never let a loan to a prince grow larger than the bank could afford to lose entirely. His son Cosimo largely kept to that discipline, personally reviewing branch accounts and refusing loans to rulers he judged unreliable, and the bank prospered enormously under his long stewardship, becoming banker to the papacy itself. The trouble began later, under Lorenzo the Magnificent, whose interests ran more naturally toward politics, art, and diplomacy than toward the ledgers his grandfather and great-grandfather had guarded so closely. Branch managers, with less oversight from Florence, extended large loans to European princes on the strength of little more than reputation and promise, including a substantial sum to Charles the Bold, Duke of Burgundy, that went unrecovered after the Duke was killed in battle in 1477 and his own duchy fell apart. By the time political upheaval, culminating in a French invasion of Italy, drove the Medici from Florence in 1494, the bank behind the family's fortune was already largely hollowed out, its branches in London and Bruges having quietly closed their doors in the years just before. The Medici name itself would recover later through politics and the papacy rather than through banking. The expulsion itself makes for the more dramatic story, and it is the one popular history tends to remember. But the financial historians who have gone back through what survives of the bank's own records generally agree that the ruin came first, quietly, in loans that should never have been made. The bank's London branch alone had extended loans to King Edward IV of England that went largely unpaid, an echo, more than a century later, of the very same mistake that had ruined the Bardi and Peruzzi in the first place, made this time by a bank that should have known the story well. The palaces stood, the ledgers did not. Jacob Fugger, called Jacob the Rich, even by his contemporaries, lent so much money to a single candidate for Holy Roman Emperor in 1519 that historians still describe the election as effectively bought, and the buyer was Fugger's own client, Charles V. The Fugger family of Augsburg had built its fortune in mining and long-distance trade, before moving into something far more lucrative and far riskier, lending directly to the great crowns of Europe. Once Charles secured his throne with an enormous bribery fund, historians estimate it several 100,000 florins, largely fronted by Fugger money. The family became the primary bankers to the Habsburg dynasty, and by extension to Spain, whose empire Charles also ruled. For a time this arrangement was extraordinarily profitable, since a banking family tied closely to an emperor enjoyed access, trust, and the kind of privileged information that ordinary merchants could only dream of. The difficulty was then the Spanish crown, despite its American silver, was a chronically unreliable payer, and its repeated suspensions of debt through the middle decades of the 16th century hit the Fuggers' balance sheet hard. Loans were forcibly converted into low-yielding government bonds worth a fraction of the cash originally advanced, and the family's exposure to a single overextended sovereign, once its greatest advantage, became its deepest vulnerability. By the generations after Jacob's death, the Fugger fortune had shrunk considerably from its early 16th century peak, and the family gradually retreated from high finance into steadier, less spectacular landholding and provincial banking, a quieter life than the one Jacob had built for them. Later European banking families would study the episode closely, and drew from it a lesson about the cost of tying a fortune too tightly to any single crown, however grand. One legacy of the family's healthier years still stands in Augsburg today. The Fuggery, a walled complex of small housing Jacob's family built for the city's deserving poor, still providing low-cost housing to this day, long after the banking empire that funded it had faded. The emperors kept their crowns, the Fuggers kept the paper. No European power received more silver from the New World than Spain in the 16th and 17th centuries, and no European power suspended payment on its debts more often. The Spanish crown defaulted, by most historians' counts, on roughly half a dozen separate occasions between the reign of Philip II and that of Philip IV, a pattern consistent enough that modern economists studying sovereign debt still cite Spain as an early, well-documented case study. The reasons were structural rather than simple carelessness. Much of the silver arriving from Potosi and Mexico was already pledged, often years in advance, through short-term loan contracts called asientos, to Genoese and German bankers who had financed the crown's wars on credit against future shipments. Spain, meanwhile, was fighting on multiple fronts at once for most of this period. Revolt in the Netherlands, wars against France, conflict with England, campaigns in Italy, all requiring soldiers who needed paying on a weekly or monthly basis, regardless of when the next treasure fleet happened to arrive. The cost of delay fell hardest on the soldiers themselves. Spain's own army in the Netherlands mutinied more than once over wages that never came. A kingdom can be extraordinarily wealthy in total resources and still run out of usable cash at the moment it is needed. And Spain did so again and again, each suspension followed by a renegotiation with its bankers, a temporary restructuring, and then, within a decade or so, another shortfall. The lesson economic historians draw from Spain's case has less to do with the size of a treasury than with its timing. Income that arrives unevenly, against obligations that arrive constantly, can bankrupt even a kingdom sitting on a literal mountain of silver. Genoese bankers, ironically, did rather well out of the arrangement over the long run, since each restructuring arrived with fresh, more favorable terms negotiated from a position of leverage, turning Spain's unreliability into a dependable source of their own steady profit. The galleons kept arriving, the treasury stayed empty. John Law had fled Britain years earlier after killing a man in a duel over a woman, and by 1716, remarkably, France had made him the architect of its national finances. France emerged from the long wars of Louis XIV's reign, crushed under debt it had little practical hope of repaying through ordinary taxation, and the young regent governing in the new king's name was open to unconventional ideas. Law believed that a nation's prosperity depended less on how much gold and silver it held than on how freely money could circulate. And he convinced the regent to let him establish a bank whose paper notes the state itself would guarantee. He then merged that bank with the Mississippi Company, granted a monopoly over trade with France's vast, largely unexplored Louisiana territory, and began selling shares in the company to a Parisian public hungry for a piece of the promised riches. The share price climbed extraordinarily as speculation fed on itself, so many buyers crowding the narrow room outside the company's offices that a new word, millionaire, is said to have entered French usage to describe the sudden fortunes being made there on paper. Louisiana's actual riches, of course, were vastly overstated, little more than distant forests and unproven rivers of gold. When doubts began to spread and note holders tried converting their paper back into metal, the government's attempts to restrict withdrawals only accelerated the loss of confidence. By the autumn of 1720, both the shares and the currency scheme behind them had collapsed together, wiping out fortunes across every level of Parisian society that had bought in during the final, most feverish months, and Law, disgraced, fled France in disguise, eventually dying in relative poverty in Venice. France's experience with Law's scheme left such a deep scar that the country avoided paper currency almost entirely for the better part of a century afterward, a caution that arguably left its financial system less flexible than rivals it would later struggle to keep pace with. He had promised a currency backed by the future, and the future did not pay. On a strip of jungle coastline in Panama in 1698, a few hundred Scottish colonists began building a settlement they called New Caledonia, certain it would make their small, poor nation as wealthy as England. The Company of Scotland had raised the funds for the venture from investors across nearly every level of Scottish society, a sum equal to roughly a fifth of the nation's entire circulating wealth, drawn from merchants, nobles, and ordinary savers who had all heard the same promise. A Scottish colony astride the narrow neck of Panama could control trade between the Atlantic and Pacific and make the country rich almost overnight. What the promoters had not adequately reckoned with was the reality of the place itself. The ships had been loaded with goods better suited to Scottish tastes than tropical ones: wool blankets, combs, and mirrors that found few buyers among the local Guna people or the Spanish colonists nearby, while tropical disease killed settlers at a punishing rate, and the terrain proved far harder to farm or fortify than anyone in Edinburgh had imagined. Neither England, protective of its own colonial interests, nor Spain, which claimed the territory as its own, offered any support. More than 4 out of every 5 colonists who sailed for Darien did not survive their first year there, and the settlement was abandoned within months. A second wave of hopeful colonists had already set sail from Scotland before news of that failure could reach them, and arrived to find the settlement they were meant to join already empty. The financial loss was severe enough to threaten the solvency of much of the Scottish nobility, and historians generally count it among the pressures that pushed Scotland toward political union with England in 1707, a settlement that included a cash payment called the equivalent, partly intended to compensate the scheme's ruined investors. The site itself was left largely undisturbed for generations afterward, a quiet stretch of coastline that gave no outward sign of the fortune or the lives it had once cost a nation thousands of miles away. Union followed ruin, the way it so often does. A note printed in the Chinese province of Sichuan in the 11th century carried no gold or silver behind it at all. Only a government promise, and it may be the oldest paper currency any state ever issued. Sichuan's local currency at the time was a heavy, low-value iron coin, useful enough for small transactions but genuinely burdensome to carry in any quantity. And merchants there had begun issuing private paper receipts, known as jiaozi, as a lighter substitute backed by coin held on deposit. The Song dynasty government, recognizing both the convenience and the potential revenue, took over their issuance directly, and for a time the system worked roughly as intended, with paper trading at close to its stated value in coin. The trouble, as it would be for governments printing paper money ever since, was restraint. Facing the enormous costs of war and administration, first the Song and later the Jin and Yuan dynasties that followed printed considerably more paper currency than the economy could realistically absorb, and its purchasing power eroded in successive waves across the following centuries, sometimes gradually, sometimes in sharper collapses tied to specific military crises. Merchants grew wary of holding notes for long. Prices quoted in paper drifted further and further from prices quoted in coin, and confidence, once badly shaken, proved difficult to fully rebuild even under later, more disciplined administrations. Centuries afterward, under the Yuan dynasty, the Venetian traveler Marco Polo would describe the emperor's paper currency to disbelieving readers back home as one of the great marvels of Kublai Khan's court, a government turning ordinary paper into something a merchant would accept as readily as silver. Historians of money still regard the episode as a remarkably early preview of a pattern that would recur far from China, centuries later, in France under John Law, and in revolutionary America. The pattern repeated itself almost exactly under the Jin dynasty that conquered northern China, whose own paper notes, called jiaochao, followed much the same arc of early success and eventual overissuance within only a few generations. Paper had made trade lighter to carry. It also made trust considerably easier to spend. There is an old saying, not worth a Continental, and it began as a literal description of a piece of paper money rather than as a figure of speech. When the Continental Congress took on the task of funding the Revolutionary War in 1775, it had no power to tax the colonies directly, and no gold or silver reserve worth mentioning. So it did the only thing available to it. It printed paper currency and promised the notes would eventually be honored. As the war dragged on and expenses mounted year after year, the Congress kept printing, since there was little else it could do to pay soldiers and buy supplies, and each new run of notes diluted the value of the ones already in circulation. By the early 1780s, a continental dollar was trading at a small fraction of its face value, and in many transactions, merchants simply refused to accept it at all, insisting on hard currency or barter instead. Soldiers who had been paid in continentals, some of them owed months of back wages, found their pay worth barely enough to matter by the time they could spend it, a hardship that fed real unrest within the ranks during the war's harder years. The experience left a deep and lasting wariness of paper money among the men who would go on to write the Constitution a few years later. One of the reasons that document explicitly restricts individual states from issuing their own paper currency. Alexander Hamilton, who watched the Continentals collapse firsthand, spent much of his later career as Treasury Secretary trying to build a financial system sturdy enough that the new nation would never have to repeat the experiment. Individual states issued their own competing paper currencies during the same period, most suffering a similar fate, so that a merchant weighing whether to accept payment in continental dollars, Virginia pounds, or Pennsylvania pounds had good reason to distrust nearly all of it equally by the war's final years. The dollar that eventually replaced it carried the name onward, but for a long while, none of its reputation. The Dutch East India Company was, for much of the 17th century, the most valuable trading company that had ever existed, and its shareholders received one of history's earliest reliable dividends, paid out nearly every year for the better part of 2 centuries. Founded in 1602, the company pioneered the idea of a joint stock enterprise whose shares could be freely bought and sold on a formal exchange in Amsterdam, spreading the risk of dangerous, expensive voyages to Asia across thousands of investors rather than a handful of merchants willing to risk everything on a single ship. For much of the 1600s, this model worked spectacularly, funding a trading empire that stretched from the Cape of Good Hope to Japan. The decline, when it came, arrived slowly rather than all at once. Maintaining fortified trading posts and private armies across Asia grew steadily more expensive through the 18th century. Competition from British and other rivals ate into once dominant spice margins, and corruption among the company's own overseas officials, who often ran private trade alongside the company's business, quietly drained profits that never made it back to Amsterdam. For years, the company kept paying its famous dividends anyway, increasingly by borrowing rather than from any real trading profit, a choice that flattered its shareholders while masking just how hollow the enterprise had become underneath. By 1799, its debts had grown so far beyond its remaining assets that the Dutch government formally dissolved the company, absorbing what remained of its colonial holdings directly into state control. Maintaining a private army and a fortified colonial capital at Batavia grew more expensive every decade, even as spices that had once been rare luxuries in Europe became increasingly ordinary, and their prices fell to match. Its Amsterdam headquarters and warehouses were sold off piecemeal in the years that followed, physical remnants of an empire that had, at its height, employed tens of thousands of sailors, soldiers, and clerks across half the known trading world. The first great company in history did not die suddenly in a single crash. It simply, over the better part of a century, ran out of road. William Duer had helped write the very rules of American public credit, and then he broke nearly every one of them for his own profit. Duer served as an assistant to Alexander Hamilton at the newly formed Treasury Department in the earliest days of the American Republic, a position that gave him detailed knowledge of the government's plans for its debt and its new national bank. He left the post and used that knowledge, along with money borrowed heavily and often informally from friends, family, and anyone who would lend to a man of his reputation, to speculate aggressively in government securities and bank stock, attempting at one point to corner the market in shares of the fledgling Bank of New York. His position depended entirely on prices continuing to rise, and when they did not, his borrowing outran his ability to cover it. Duer's default in March of 1792 triggered a sudden and severe credit crunch across New York's small, tightly connected financial community, an event now remembered as the Panic of 1792, the young nation's first genuine financial crisis. Hamilton, recognizing how easily the collapse could undermine confidence in the entire new system of public credit he had spent years building, intervened directly, directing the government to buy securities in the open market to stop prices from falling further, an early and largely successful example of a central financial authority acting to calm a panic rather than simply watching it burn out. The panic spread quickly enough through New York's small, interconnected merchant community that ordinary shopkeepers and tradesmen who had never bought a single security found their own credit tightening within days, a reminder of how closely even modest local commerce depended on confidence in the same financial system Duer had gamed. Duer himself, ruined and pursued by creditors, was thrown into a New York debtor's prison where he remained until his death several years later. Confidence in the young nation's bonds recovered within months rather than years, a testament less to any particular policy than to how quickly Hamilton's intervention restored the sense that someone credible was, in fact, in charge. The man who helped design the system was undone by exactly the loophole he knew best. In 1822, a Scottish soldier named Gregor MacGregor stood before London investors and described a fertile Central American nation called Poyais, complete with a functioning government, its own currency, and a handsome capital city called St. Joseph. MacGregor had served with genuine if modest distinction in South America's wars of independence, and that background lent his claims an air of credibility they otherwise never would have earned. He had in fact briefly visited a stretch of coastline in what is now Honduras, and from that thin thread of truth he invented an entire country, a coat of arms, printed Poyaisian currency, land certificates sold by the acre, and eventually government bonds offered on the London Exchange that raised a very real fortune from very real investors. He went further still, recruiting actual settlers, tradesmen, and their families, eager to build new lives in this promised land, complete with printed guidebooks describing the country's rich soil and thriving towns. 2 ships of hopeful emigrants sailed for the coast in 1822 and 1823, and found on arrival no city, no government, no towns at all, only dense and largely uninhabited jungle. Disease and starvation killed a substantial share of the settlers before rescue ships from British Honduras finally reached the survivors. MacGregor himself was later tried in France on related fraud charges, was acquitted on a technicality, and lived out most of his remaining years without serious punishment, at one point even attempting a smaller version of the very same scheme. Remarkably, MacGregor's reputation recovered enough within a few years that he found new investors willing to buy Poyaisian bonds a second time, a testament less to his charm, historians generally agree, than to how badly London's investing public wanted to believe in an easy fortune overseas. The roughly 200 survivors who did make it back to Britain arrived to newspaper coverage that turned MacGregor's fraud into a minor sensation. Their public fascination with the story faded within a few years, long before his later smaller attempts at the same scheme drew any comparable attention. The map he had sold investors was beautifully drawn and entirely empty. What happens to investors when an entire continent of new markets opens at once? In 1825, London found out. Spain's colonies across Latin America had spent the early 1820s winning their independence, and for British investors this meant, for the first time in centuries, direct access to a region long rumored to hold enormous mineral wealth. Money poured into a wave of newly chartered joint stock companies promising to extract silver and gold from mines in Mexico, Peru, Colombia, and beyond. Some of these companies had genuine claims, real geologists, and honest intentions. Others existed mostly as names on a prospectus, riding the same wave of enthusiasm without troubling themselves over whether the mines they claimed to operate could be reached, let alone worked profitably. Credit expanded rapidly to fund all of it, and the Bank of England's own gold reserves came under real strain as speculative lending grew far faster than the underlying economy. When confidence finally broke late in 1825, the collapse was swift and severe. Dozens of country banks across England failed within weeks, and the panic grew serious enough that the Bank of England had to take emergency measures simply to keep the broader financial system functioning. Economic historians sometimes describe the episode as one of the first genuinely modern financial crises, since it arose less from any single act of fraud than from ordinary credit and speculation expanding faster than anyone could properly assess. Some of the companies chartered that year, including ventures such as the Anglo-Mexican Mining Association, did send real geologists to inspect real deposits, and their reports, filtered back to London through weeks of travel, tended to grow more optimistic with each retelling, long before any ore had actually been extracted and sold. The Bank of England drew a lasting institutional lesson from how close the crisis had come to overwhelming its own reserves, and began holding meaningfully larger gold reserves as a matter of policy in the years that followed, a quiet but durable legacy of a single chaotic year. A newly opened market rewards excitement long before it ever gets around to rewarding patience. In 1836, President Andrew Jackson signed an order requiring anyone buying federal land to pay in gold or silver rather than paper banknotes, meaning to cool a runaway land speculation boom that had been building for years. The preceding years had seen enormous speculative buying of Western federal land, financed largely by loosely regulated paper money issued by state banks that varied wildly in how much actual metal backed their notes. Land offices did record business, much of it fueled by buyers who intended to resell quickly rather than settle the land at all. Jackson, deeply distrustful of paper currency and of banks generally, having spent years fighting to dismantle the Second Bank of the United States, issued what became known as the Specie circular in hopes of forcing a return to sound metal-backed transactions. The immediate effect was a sudden surge in demand for hard currency, which drained many banks of their gold and silver reserves, just as a separate and largely unrelated tightening of credit in Britain was also squeezing American banks that depended on London capital. The combination proved more than the financial system could absorb. The Panic of 1837 that followed brought a wave of bank failures and business closures, and the depression it opened stretched on, by some assessments, for the better part of 6 years, among the longest downturns the young country had yet experienced. Jackson's own successor, Martin Van Buren, inherited the collapse within weeks of taking office, and spent much of his single term defending policies he had not designed against a depression he could not easily fix, a political burden that likely cost him re-election. Historians have argued for generations over how much blame belongs to Jackson's policy and how much to forces entirely outside his control. Congress itself repealed the Specie circular in 1838, though by then the deeper damage to bank confidence had already been done and could not simply be legislated back into existence. The policy meant to slow one fire helped light another, several states away. By the mid-1840s, British investors were pouring money into railway shares so fast that the capital proposed for new lines in a single year rivaled, by some later estimates, a substantial share of the entire national economy. Railways were not an empty promise. They were a genuinely transformative technology that had already proven both useful and profitable through the 1830s, moving goods and people faster than anything before them. That real success is precisely what invited the excess that followed. Hundreds of new railway companies sought parliamentary approval through the mid-1840s, promising lines to every corner of the country, many of them with little realistic chance of ever being built or turning a profit. Newspapers covered the boom enthusiastically, and shares in even the most barely planned companies traded actively on rumor and momentum alone, changing hands among investors who had never seen the proposed route and had no intention of ever riding the finish line. When confidence finally broke across 1846 and 1847, share prices for railway companies collapsed broadly and quickly, ruining a great many smaller investors who had bought in on installment plans, paying only a fraction of a share's price up front and finding themselves liable for the rest, just as the value of what they owned was disappearing. The technology itself, unlike the money poured into it, survived the crash and eventually proved its worth, leaving Britain with a denser rail network than a more cautious approach would likely have built. One promoter, George Hudson, became known across Britain as the Railway King for the sheer scale of the lines he controlled, before investigators discovered he had been paying shareholder dividends out of capital rather than genuine earnings, a discovery that ended his career as abruptly as the Mania itself had ended. One lasting, almost accidental benefit did emerge from the chaos. The sheer number of competing lines built during the Mania forced Parliament to pass the Gauge Act of 1846, standardizing the width of British track and sparing the country the costly permanent muddle of incompatible rail networks some other nations were left sorting out for decades afterward. The rails outlived the fortunes that laid them. In the year 33, Roman courts began enforcing a decades-old law requiring lenders to keep a fixed share of their capital invested in Italian land, a rule most bankers had long since stopped bothering to observe. The sudden revival of this old requirement, layered on top of a broader tightening that had followed a wave of earlier confiscations, forced many of Rome's lenders to call in outstanding loans quickly in order to comply, draining coin out of ordinary commerce all at once. Borrowers who could not repay on short notice had little choice but to sell land to raise cash, and so much land came onto the market at the same moment that its price collapsed. The historian Tacitus, writing decades later but drawing on records close to the events, described a scarcity of money severe enough that a great many people were, in his account, utterly ruined by it, unable to sell assets for anything close to what they had been worth only months before. The Emperor Tiberius, recognizing the danger this posed to Rome's wider economy and not merely to a handful of unlucky lenders, had the imperial treasury distribute 100 million sesterces in interest-free loans, secured against land valued at twice the loan amount and repayable over 3 years, a deliberate injection of liquidity meant to let prices stabilize rather than keep collapsing. The intervention worked. Commerce gradually resumed its normal rhythm, and the crisis passed without further escalation. Modern economists who have studied Tacitus's account note how familiar the underlying mechanism feels: a sudden regulatory tightening, a rush to call in credit, and a collapse in the price of the collateral everyone was relying on. A sequence separated from more recent credit crises by nearly 2,000 years, but not, in its basic shape, by very much else. Roman coin hoards from this exact period, recovered by archaeologists centuries later, show a brief but noticeable spike in coins buried for safekeeping, a physical trace of ordinary people responding to the very same panic Tacitus described in words. Even an empire that minted its own coin could not simply wish a credit crunch away. For a few days in September 1869, two of the most brazen financiers in New York very nearly controlled the price of gold for the entire United States. Jay Gould and Jim Fisk devised a scheme to corner the nation's gold market, quietly buying up as much of the available supply as they could, while simultaneously working to keep the federal government from selling its own reserves onto the market, using a personal connection to President Grant's brother-in-law to gain influence over the administration's intentions. As their buying pushed the price of gold steadily higher through the summer, businesses that depended on a stable exchange rate for foreign trade, importers and exporters alike, found their ordinary commerce badly disrupted by a price moving for reasons that had nothing to do with actual supply or demand. Grant, once alerted to the scheme by advisors alarmed at the damage it was doing, ordered the Treasury to release a substantial quantity of government gold onto the open market on the 24th of September. The price collapsed within minutes of the announcement, a crash so sudden and so violent to fortunes built on the other side of the trade that the day became known ever after as Black Friday. Gould, forewarned of the coming reversal through his own network, managed to sell out of his position just ahead of the crash and escaped largely unharmed. Fisk and many of their smaller associates were not so fortunate and were ruined within the hour. American farmers felt the aftershock most directly, since the artificially inflated gold price had briefly disrupted the exchange rates on which grain exports depended, delaying and complicating sales that ordinary agricultural communities across the country relied on. Congress later investigated the episode at length, and while Grant himself was never implicated in any wrongdoing, the scandal left his young administration with a reputation for cronyism it never entirely shook off. Gould left the corner richer than he entered it. Almost no one else caught in it could say the same. On the 18th of September, 1873, the doors of J. Cook & Company, one of the most respected banking houses in the United States, closed without warning, and the New York Stock Exchange itself shut its doors for 10 days rather than face the panic that followed. Cook's firm had financed enormous railroad construction, particularly the ambitious Northern Pacific Line, on the assumption that a steady flow of European capital would keep funding American expansion indefinitely. When financial troubles overseas, including a closely related crash in Vienna that same year, dried up that flow of foreign investment, Cook's overextended firm found itself unable to meet its obligations and collapsed almost overnight. The failure of a house so widely trusted triggered a wave of bank runs and business failures across the country, and the depression that opened in its wake stretched on for years, with falling wages and rising unemployment feeding labor unrest that included major railroad strikes later in the decade. Economic historians today consider the Panic of 1873 one of the least remembered of America's major financial crises, overshadowed in popular memory by the Civil War that preceded it by less than a decade and by the visible excess of the Gilded Age that followed it. At the time, though, it was simply called the Great Depression, a name history would later reassign to a still larger crisis 6 decades on, leaving this earlier one to fade quietly out of common memory despite its considerable scale at the time. Soup kitchens and makeshift shelters appeared in major cities that winter to feed men thrown suddenly out of work. An early and largely forgotten dress rehearsal for scenes that would return, on a far larger scale, 6 decades later. Cook's own personal fortune, built over decades financing the Union war effort through bond sales, was wiped out almost entirely alongside his firm, a detail contemporaries found especially striking, given how instrumental he had been to the nation's finances only a decade earlier. The rails kept expanding through it all. The men who financed the first mile rarely lived to see the last. For decades, London bankers had a phrase for the safest possible place to put their money. As safe as the house of O.H. Varenne and Gurney. The firm operated as what was known as a discount house, a specialist business that bought short-term IOUs called bills of exchange from merchants at a small discount, giving the merchant immediate cash and earning a modest, reliable profit once the bill matured and paid in full. Under its founder, the Quaker banker Samuel Gurney, the firm built its reputation over decades on exactly this kind of careful, unglamorous lending, so consistently sound that other bankers genuinely used its name as shorthand for safety itself. After Gurney's retirement and death, newer partners quietly shifted the business away from that cautious model, extending longer-term, far riskier loans to shipping and railway ventures, some of which were already in financial trouble by the time O.H. Varenne Gurney lent to them. In 1865, the firm converted itself into a public limited company, selling shares to outside investors just months before its hidden troubles came to light. When a cluster of its riskier loans turned bad, the firm suspended payment in May 1866, an announcement that triggered a bank run and a citywide panic, dragging several other London banks down with it, before the Bank of England, having initially hesitated to rescue a firm that had in some ways been a rival, finally stepped in to calm the broader market. The episode strongly shaped the economist Walter Badut's later, highly influential writing on how a central bank ought to act as lender of last resort in exactly this kind of crisis. Thousands of the ordinary shareholders who had bought into the firm's public offering only months earlier lost most of what they had put in, a detail contemporaries found especially bitter, given how recently the firm had still been considered the very model of banking caution. Several of the firm's own former partners faced criminal trial afterward on charges of fraud, though a jury ultimately acquitted them, ruling their conduct reckless rather than deliberately dishonest. It takes decades to build trust like that, and considerably less than a season to spend it. By 1875, the Ottoman Empire was borrowing simply to pay the interest on money it had already borrowed, and that October it stopped even managing that. Through the 19th century, the Ottoman state had taken on substantial foreign debt, mostly from British and French bondholders, to fund a broad program of modernization, ongoing military campaigns, and, under certain sultans, considerable palace extravagance. By the mid-1870s, interest payments alone consumed a large share of all state revenue, leaving the treasury with barely enough left over to govern, let alone continue investing in the reforms the borrowing had originally been meant to fund. The 1875 default, formally a suspension of half its debt payments, deepened further amid the political and military crisis of a war with Russia that broke out 2 years later, and by 1881, the empire's European creditors had negotiated a settlement, remembered as the Decree of Muharrem, that created the Ottoman Public Debt Administration. This body, staffed and directed largely by representatives of the foreign bondholders themselves, was given direct control over collecting specific Ottoman state revenues, including the salt and tobacco monopolies, to ensure the debt was serviced ahead of nearly every other government priority, employing, within a few years, thousands of its own officials, operating essentially as a parallel administration inside Ottoman territory. Historians studying sovereign debt still cite the arrangement as one of the most direct examples on record of default resulting in genuine foreign control over a state's own tax collection. The default also hit a great many ordinary British and French households directly, since Ottoman bonds had been sold widely to small investors across Europe on the strength of the empire's earlier reputation for reliable payment, and their losses added considerable political pressure behind the eventual settlement. Some historians argue the arrangement, however humiliating politically, actually improved the empire's long-term creditworthiness, since foreign investors, reassured that their interest payments were now collected directly rather than left to the state's own uneven discretion, grew willing to lend again on considerably better terms than before. The empire kept its throne. In practice, it lost the right to collect its own taxes. Ismail Pasha wanted Cairo to look like Paris, and for a while, with enough borrowed money, it very nearly did. As the ruler of Egypt from 1863 to 1879, nominally still under Ottoman authority, but governing with considerable independence, Ismail pursued an ambitious modernization program, broad new boulevards, an opera house, expanding rail lines, and the completion of the Suez Canal, opened in 1869 with lavish ceremonies attended by European royalty. Almost none of it was paid for out of Egypt's own revenue. Ismail borrowed heavily from European lenders, often on steep discounted terms that left the government receiving far less cash than the loan's face value, while still owing the full amount back with interest, and the debt compounded quickly. By the mid-1870s, debt service was consuming most of the state's income, and in 1875, desperate for immediate cash, Ismail sold Egypt's substantial shareholding in the Suez Canal Company, roughly 44% of it, to the British government, a deal arranged swiftly by Prime Minister Disraeli and financed through the Rothschild banking house. Even that sale could not resolve the underlying debt, and within a year, Britain and France had installed their own financial controllers directly over Egyptian finances, an arrangement known as the dual control. Ismail himself was forced to abdicate in 1879 under pressure from the Ottoman Sultan and the European powers, setting the stage for Britain's outright military occupation of Egypt just 3 years later. For Britain, the purchase was about far more than a good investment. The canal had already become the fastest sea route to India, the most valuable possession in its empire, and control over its ownership was judged worth almost any price London cared to pay. Ismail himself died in exile in Istanbul several years after his forced abdication, having watched from a distance as the country he had spent so lavishly to modernize passed fully under a foreign administration's practical control. Egypt built a canal the world still uses today. It spent decades paying for the party it threw to open it. In November 1890, the directors of Barings Bank walked into the Bank of England and admitted, quietly, that London's most storied merchant bank might not be able to meet its obligations by the end of the week. Barings had grown heavily exposed to Argentine government and railway bonds during that country's borrowing boom of the 1880s, underwriting sums that dwarfed the bank's own available capital on the confidence that Argentina's growth would continue indefinitely. When Argentina's economy stumbled, weighed down by its own overborrowing, political instability, and a disappointing harvest, the value of these bonds fell sharply, and Barings found itself holding a large position it could neither sell nor refinance on any reasonable terms. The danger was not confined to Barings alone. If word of the bank's difficulties spread publicly before a solution was found, the shock to confidence risked spreading across London's entire financial system, since the Barings name alone had underwritten an enormous amount of trust for more than a century. The Bank of England, working quietly with the city's other major banking houses, organized a rescue fund guaranteeing Barings' obligations, buying enough time to unwind the troubled position in an orderly fashion over the following years, rather than in a single ruinous crash. Barings itself survived, reorganized as a limited company with considerably reduced ambitions, though the bank would eventually collapse for good more than a century later in an entirely separate and unrelated story involving a single rogue trader. London's other leading banks each pledged a share of the rescue fund in turn, aware that if Barings were allowed to fail outright, the resulting panic could easily spread to their own doors next, an early and telling demonstration that a financial system's stability sometimes depends less on any one institution's soundness than on its rival's willingness to prop it up. Argentina itself took considerably longer to recover, its own economy remaining unsettled for the better part of the following decade, as foreign investors, once so eager to lend, grew far more cautious about the country's bonds. A single overexposed name, it turned out, could still shake an entire city's confidence. American railroads had been laying track faster than passengers or freight could ever justify for the better part of a decade, and by 1893, the bill for that decade came due all at once. Railroad overbuilding through the 1880s had been financed largely with borrowed money, and by the early 1890s, a considerable number of lines carried debt their actual traffic revenue could never realistically service. At the same time, an ongoing and increasingly bitter political fight over whether the United States would remain strictly on the gold standard or expand its coinage of silver unsettled confidence in the dollar's underlying value, prompting cautious investors, foreign and domestic alike, to convert their holdings into gold and strain the Treasury's own gold reserves in the process. The failure of the Philadelphia and Reading Railroad in February 1893 set off the wider panic. Hundreds of banks and thousands of businesses failed in the months that followed. Unemployment climbed sharply, and the depression that resulted lasted for several years, among the most severe downturns of the entire century. The gold versus silver debate at the heart of the uncertainty became one of the era's defining political fights, invoked in some of the period's most memorable political speeches, and would not be fully resolved until the gold standard was formally reaffirmed by law a few years later. The Depression's human cost became visible the following year when a group of unemployed men led by the businessman Jacob Coxey marched on Washington to demand public works relief, an early and largely unsuccessful protest. Its exhausted marchers eventually arrested simply for walking on the Capitol lawn, that nonetheless became one of the very first organized demonstrations of its kind in American history. President Grover Cleveland, elected that same year, spent much of his term defending an unpopular decision to preserve the gold standard by repealing the Silver Purchase Act, many blamed, rightly or not, for triggering the panic in the first place, a stance that cost him significant standing within his own political party. Confidence in a currency, once it needs defending in public speeches, is already partway gone. In January 1795, the governor of Georgia signed into law the sale of 35 million acres of the state's western territory, an area covering much of what is now Alabama and Mississippi, at a price of roughly 1.50 cents per acre. The sale, known afterward as the Yazoo Act, went to 4 private land companies. An investigation that followed almost immediately revealed that nearly every member of the Georgia legislature, along with the governor himself, had accepted bribes of cash, land, or company shares to secure passage of the deal, with only a single legislator refusing to take any part in it. Public outrage across Georgia was severe enough that angry citizens reportedly burned copies of the act in the streets. A newly elected reform-minded legislature repealed the sale the following year, holding a ceremonial bonfire of the original act's records to underline the point. The trouble was that many of the original buyers had already resold their claims to third-party purchasers who had bought entirely in good faith and had no part whatsoever in the original bribery, creating a legal tangle that dragged on for more than a decade and eventually reached the Supreme Court in the 1810 case Fletcher v. Peck, where Chief Justice John Marshall ruled that Georgia's repeal could not retroactively void a contract that had already been legitimately transferred onward, regardless of how corrupt its origin had been. Congress finally settled the long dispute in 1814 with a cash payment to the remaining claimants. Georgia's own state records of the episode were kept so carefully afterward, if only to document the scandal from posterity, that historians today can trace nearly every bribe and every subsequent resale with unusual precision, a rare case of corruption leaving behind an exceptionally thorough paper trail of its own undoing. The lone legislator who refused any part of the bribery became, in the years afterward, something of a local folk hero for the single vote history remembered him by. A fraud voted into law, it turned out, was considerably harder to undo than the vote that had created it. A bundle of discounted railroad construction stock, handed quietly to sitting members of Congress in 1867 and 1868, bought the Union Pacific Railroad several years of freedom from any serious scrutiny. The railroad's own directors had created a separate construction company, Credit Mobilier of America, to actually build the line, and then arranged for the railroad to pay that company grossly inflated contracts for the work, funneling the resulting profits back to themselves rather than to the Union Pacific's own public shareholders. Since the railroad had received substantial federal loans and land grants to fund its construction, it remained under a degree of ongoing congressional oversight that the arrangement's architects understandably wanted to avoid. A company insider handled that risk directly, distributing credit mobilier shares, often at a steep discount to their real value, to a number of influential senators and representatives, including at least one sitting vice president of the United States. The scheme came to light in 1872, when an unrelated business dispute among the insiders spilled into public view through a wave of newspaper exposés published just ahead of that year's presidential election. A congressional investigation followed. Several members faced formal censure, though relatively few faced any harsher consequence than public embarrassment, and the scandal became a lasting symbol of the era's tangled, often quietly transactional relationship between railroad money and federal policy. Among those implicated was the sitting vice president, Schuyler Colfax, whose political career never recovered, even though he was never formally charged, and the scandal fed a broader public cynicism about government that would linger through the rest of the decade's mounting corruption stories, several of which, in the years that followed, involved some of these very same familiar names. The scandal contributed to a broader public demand for stronger conflict of interest rules in Congress, reforms that took decades to fully take hold, but that traced part of their origin back to this exact episode. The railroad reached the Pacific on schedule. The bill for reaching it was quietly passed along to the public. A savings and loan association was, for most of the 20th century, one of the dullest possible places to keep money. It took in local deposits and lent them out as conservative home mortgages and did very little else. Deregulation through the early 1980s, intended partly to help these thrifts compete against newer investment options offering higher returns to depositors, freed savings and loans to move into far riskier territory: commercial real estate, speculative development, and high-yield corporate debt. A great many institutions, run by executives with decades of experience in dull, conservative mortgage lending, but comparatively little in assessing genuine investment risk, expanded aggressively into this unfamiliar ground, just as federal deposit insurance ensured that ordinary depositors themselves had little practical reason to monitor how carefully their own bank was actually being managed. The combination of loosened rules, inexperienced risk-taking, and in a number of well-documented cases, outright fraud by executives who understood exactly how little scrutiny they faced, led to the failure of a substantial share of the nation's thrifts by the early 1990s. Resolving the crisis required a dedicated federal agency and a cleanup effort spanning most of a decade, ultimately costing taxpayers a considerable sum once all the failed institutions' soured assets had finally been sold off or written down. One case became especially notorious. The financier Charles Keating's Lincoln Savings and Loan collapsed after years of increasingly reckless investment, and the revelation that 5 sitting United States senators had personally intervened with regulators on Keating's behalf after receiving substantial campaign contributions from him became its own separate scandal, remembered afterward as the Keating 5 affair. The federal government eventually created a dedicated agency, the Resolution Trust Corporation, specifically to sell off the mountain of soured real estate and other assets left behind by the failed thrifts, a cleanup effort that took most of the 1990s to substantially complete. The dullest business in banking, once made genuinely exciting for a decade, stopped being safe for a great many depositors who had never asked for the excitement in the first place. In the mid-1920s, a plot of raw, undeveloped land outside Miami could change hands 3 or 4 times in a single afternoon, its price climbing a little with every sale, without a single new building ever appearing on it. Florida's warm climate, newly expanded rail and road access, and aggressive, imaginative salesmanship drew a wave of buyers and speculators from across the country, beginning around 1923. Developers sold lots sight unseen on generous installment plans, some of the land amounting to little more than swamp that would require extensive draining before anyone could build on it at all. All of it marketed through elaborate brochures promising a tropical paradise, just a short train ride from the cold northern winters most buyers were fleeing. Prices climbed for roughly 2 years on pure momentum, most buyers reselling their paper contracts to the next hopeful purchaser long before any actual construction had begun on the land itself. The boom was already faltering by 1925, as new buyers grew harder to find and canceled contracts began to mount, and a severe hurricane that struck in September 1926 delivered a further, very literal blow, destroying property and confidence in more or less the same afternoon. National attention was elsewhere as Florida's bust unfolded quietly, years ahead of the far larger stock market crash that would soon dwarf it in public memory. Developers such as Carl Fisher, who had already built Miami Beach out of what was largely mangrove swamp, and George Merrick, who was busy laying out the elaborately planned suburb of Coral Gables, became minor national celebrities during the boom's peak years, their success stories doing as much as any glossy brochure ever could to draw a fresh wave of hopeful buyers south each winter. Many of the era's grandest planned communities, including some later abandoned mid-construction, left behind street grids and ornamental gateways scattered through Florida's scrubland that outlasted the boom itself by decades. Florida's bubble popped years early, and almost no one outside the state noticed at the time. Charles Ponzi's original idea was not entirely foolish. International reply coupons, a kind of prepaid postal voucher, could genuinely be bought cheaply in one country and redeemed for more valuable postage in another. In Boston through 1919 and 1920, Ponzi promised investors outsized returns, commonly cited at around 50% within just 45 days, claiming the profits came entirely from this postal coupon arbitrage conducted at scale. The real trade, even carried out with total efficiency, could never have generated remotely enough profit to support the returns he was promising to the volume of investors he was attracting. He paid his earliest investors with money raised from the wave of new investors who followed, and word of the seemingly reliable, spectacular returns spread fast through Boston, drawing in thousands of people, many of them working-class residents, investing hard-earned savings on the strength of neighbors' enthusiastic word of mouth. The scheme required an ever larger flow of new money simply to keep paying earlier investors what they had been promised, and once journalistic investigation raised public doubts and a bank examination revealed the company held nowhere near enough real assets to cover its obligations, the whole arrangement collapsed within months of its most frenzied growth, in the summer of 1920. Ponzi served prison time on both state and federal charges, was eventually deported to Italy, and died decades later in relative poverty in Brazil. When the scheme finally collapsed, investigators found the company holding assets worth only a small fraction of what it owed, and the roughly 40,000 people who had invested ultimately recovered only a modest portion of their money, years after Ponzi himself had already been sent to prison and his name had permanently attached itself to the scheme. The genuine postal coupon arbitrage he had originally described, modest and legitimate on the small scale where it actually worked, continued to exist quietly in the background of international mail systems, long after his own name had become a byword for something else entirely. The idea behind it was real. Everything built on top of the idea was not. On a single Tuesday in October 1929, the New York Stock Exchange lost more paper value than many nations' entire economies were worth that year. And the selling did not meaningfully stop for days. The boom that preceded it had run for most of the decade, fed by widespread margin buying, a practice that let an investor purchase stock with borrowed money, paying only a small fraction of the price up front, and pledging the shares themselves as collateral for the rest. Rising prices made this look effortless, and new investment trusts sprang up that piled leverage on top of leverage, borrowing to buy shares in other companies that had themselves borrowed to buy still more shares. By the late summer of 1929, share prices for many companies had climbed well beyond what their actual earnings could reasonably justify by nearly any contemporary measure of value. Late October brought the reckoning, a wave of panic selling on the 24th, then a still steeper collapse on the 28th and 29th, days remembered afterward as Black Thursday and Black Tuesday. A group of major bankers attempted a coordinated show of confidence, buying shares publicly to steady the market, echoing a similar rescue that had worked in 1907, but this time the effort barely slowed the fall. The market continued sliding for years afterward, and by the middle of 1932, stocks had lost the vast majority of their peak value. The crash alone did not cause the Great Depression that followed, but it exposed and accelerated deeper weaknesses already sitting in the banking system and farm economy that turned a sharp correction into a decade-long crisis. Investors who had bought conservatively, without borrowed money, still lost real savings as the broader economy contracted in the years that followed. A reminder that a crash of this size rarely stays confined to the people who took the largest risks. Unemployment in the United States climbed toward roughly a quarter of the workforce within a few years of the crash, a scale of hardship the stock ticker's own falling numbers could never fully have predicted on their own. The closing bell rang that October, exactly as it did on any other day. Almost nothing else about the market did. In May 1931, the depositors lining up outside the doors of Austria's largest bank in Vienna could not have known they were watching the opening act of a crisis that would reach banks a continent away within a matter of weeks. Kreditanstalt had spent the preceding years absorbing a number of weaker rival banks, a consolidation the Austrian government had actively encouraged in hopes of stabilizing a banking sector still unsettled by the dislocations of the First World War. Each acquisition brought Kreditanstalt not just new depositors and new business, but the bad loans its struggling rivals had already been quietly carrying. And by 1931, those inherited losses had grown too large to keep hidden. Once the bank's true condition became public, panic spread with striking speed, a direct consequence of just how tightly European banks had become interconnected through cross-border lending built up during the Reconstruction years after the war. German banks, themselves heavily exposed to Austrian borrowers and carrying plenty of shaky loans of their own, faced serious runs within weeks, part of a wider wave of European bank failures that swept through the summer of 1931. International efforts to organize a rescue were slowed by unrelated political tensions, including bitter disputes over war reparations and a proposed customs union between Austria and Germany that alarmed France enough to complicate cooperation just when it was needed most. Economic historians generally regard the Kreditanstalt collapse as a major accelerant that helped turn an already serious American downturn into a genuinely global depression. Unemployment across Central Europe climbed sharply in the crisis's wake, and the political instability that followed in Germany over the next 2 years is counted by many historians among the conditions that allowed more extreme political movements to gain ground. Britain itself abandoned the gold standard only months later, in September of 1931, a decision that traced a direct line back to the pressure the Kreditanstalt collapse had placed on the entire European financial system that summer. One bank's bad loans, tied tightly enough to the rest of the system, became everyone's problem within a single season. By the autumn of 1923, a loaf of bread bought in Berlin at breakfast could cost noticeably more by the same evening. And workers had taken to being paid twice a day just to spend their wages before the next price increase caught up with them. The roots of the crisis reached back to the First World War. Heavy war debt, the loss of resource-rich territory under the peace settlement, and reparations payments imposed by the Treaty of Versailles that Germany's post-war economy struggled to meet from ordinary revenue. The immediate trigger came in 1923 when France and Belgium occupied Germany's industrial Ruhr region after Germany fell behind on reparations in kind. And the German government responded by printing money to pay striking Ruhr workers and cover the resulting general strike, a decision that broke whatever restraint remained in its currency policy. The mark's value disintegrated within months. Photographs from the period, still widely reproduced today, show people carrying stacks of banknotes in suitcases and wheelbarrows simply to buy groceries. And some Germans found it genuinely cheaper to burn bundles of cash for warmth than to buy firewood with the same money. The hyperinflation wiped out savings across the German middle class almost entirely, a trauma that lingered in the country's economic memory and political culture for the rest of the century. A currency reform introducing the new Ren 10 mark in November 1923 finally halted the collapse, though the damage to public trust in paper money took considerably longer to repair. Pensioners and small savers who had spent decades setting aside money in good faith watched it become effectively worthless within months, while anyone holding real assets or foreign currency came through the crisis largely unscathed, a lopsided outcome that fed lasting resentment long after the immediate emergency had passed. The trauma of watching a lifetime of savings evaporate within months left a lasting mark on German economic policy for the rest of the century, a caution against loose monetary policy that outlived the Weimar Republic itself by generations. The mark did not fail quietly, tucked away in some ledger. It failed by the hour, in plain public view. Ivar Kreuger built a match manufacturing empire that, at its height, controlled somewhere between 2/3 and 3/4 of the entire world's match production, financed almost entirely by debts that no outside auditor was ever allowed to see in full. Kreuger's method was consistent across dozens of countries: negotiate an exclusive match monopoly with a cash-strapped government, often in the aftermath of the First World War, in exchange for a large loan that government badly needed. He funded these loans by selling bonds to investors, heavily marketed in the United States, on the strength of his company's reported earnings, which looked steady, generous, and remarkably dependable year after year. In reality, a considerable share of those earnings existed only on paper, produced through complicated, deliberately opaque accounting, spread across a tangle of subsidiaries and shell companies, and Kreuger had gone so far as to forge a portfolio of supposedly genuine Italian government bonds to bolster his company's reported assets. The scheme held together for years, helped along by Kreuger's carefully cultivated reputation for personal reliability, and by his insistence that no single auditor, banker, or board member ever be allowed to see his entire empire's finances at once. As the Depression squeezed government budgets through 1930 and 1931, his loan for monopoly model grew far harder to sustain, and the cracks began to show. Kreuger was found dead in his Paris apartment in March 1932, his death ruled a suicide, only days before the true scale of the fraud became fully public, and a subsequent investigation revealed his company's reported assets had been vastly overstated for years. Investors across Sweden, the United States, and beyond, who had trusted his bonds as among the safest available, recovered only a fraction of what they had put in once the true state of the company's finances finally came to light in the months after his death. The scandal prompted lasting reforms to how American regulators reviewed foreign securities sold to the public, part of the broader wave of financial oversight introduced in the years just afterward. The empire outlived its own true numbers by several years. It did not outlive its founder by long. Inspectors sent to certify the vegetable oil backing a commodities trader's loans checked exactly one thing: that the storage tanks, when sounded from an access hatch at the top, showed oil to roughly the expected depth. Tino De Angelis ran a vegetable oil refining and trading company in New Jersey through the early 1960s, and he used seemingly enormous inventories of soybean and cottonseed oil as collateral for large bank loans and commodity trading positions. The inspectors who measured tank contents from the top were fooled by a simple trick of physics. Many of the tanks were mostly filled with water or seawater, with only a shallow layer of real oil floating on the surface, since oil is lighter and rises above water. A network of pipes connecting several tanks also let De Angelis' staff quietly shuffle a modest quantity of genuine oil from tank to tank ahead of each scheduled inspection, so the same real oil could seem to appear in several different places over the course of one audit. The scheme finally unraveled in November 1963, when creditors, unsettled by unrelated market news, tried calling in loans all at once and discovered the collateral securing them barely existed at all. American Express, whose warehousing subsidiary had issued official receipts certifying oil that was never really there, took a serious financial hit and a lasting reputational scare from its association with the fraud. De Angelis was convicted on multiple counts and served several years in prison before being released. The episode prompted lasting changes to how commodity warehousing was audited afterward, since regulators realized that a signed receipt, however official-looking, was never actually a substitute for someone climbing down and checking what a tank truly held, rather than trusting what its surface alone appeared to show. American Express itself very nearly abandoned its warehousing business entirely over the resulting losses before a young executive named Howard Clark helped steer the company through the crisis and within a decade into its presidency. No one had thought to check what was underneath the oil, because in that business, no one ever had before. Nelson Bunker Hunt was, by some estimates, one of the richest private citizens in the world when he and his brother William Herbert decided the safest place for a meaningful share of that fortune was several $100 million worth of physical silver. The brothers began quietly accumulating silver bullion and futures contracts in the mid-1970s, partly as a hedge against inflation that was already running high, then escalated their buying through the decade's end into what amounted to an attempt to corner the market by controlling a very large share of all deliverable supply. The price of silver, which had traded for only a few dollars an ounce earlier in the decade, rose dramatically through 1979 and into early 1980, climbing toward a peak near $50 an ounce, as the Hunts, joined by several wealthy partners, including some Middle Eastern investors, kept buying more. Commodity exchange officials, alarmed at how badly the position was distorting the ordinary market, changed margin rules specifically aimed at the Hunts, requiring far more cash collateral to hold the same size of contracts. When the brothers could not meet the resulting margin call, the price collapsed in a single trading session on the 27th of March, 1980, a day still remembered on trading floors as Silver Thursday. The Hunts were left owing enormous sums. Several major banks organized an emergency line of credit to prevent the fallout from spreading to other firms with exposure to them. And Bunker Hunt was later found civilly liable for market manipulation, eventually filing for bankruptcy years afterward. Ordinary jewelers and silver dealers across the country felt the distortion directly during the run-up, melting down silverware and coins to sell into a suddenly lucrative market, only to watch the same silver's value collapse again within days of the peak. Everyday consumers felt a strange, brief side effect of the frenzy too, as the sudden value of silverware and coin collections sent ordinary households digging through drawers and attics for anything worth melting down. Even a fortune built on oil could not outbuy an entire commodity market forever. By the late 1980s, a membership to an exclusive Tokyo golf club could cost more than an ordinary house, and people bought them anyway, entirely confident the price would simply keep climbing the way it always had. Loose monetary policy through the 1980s, adopted partly in response to the strengthening yen following the 1985 Plaza Accord among major economies, made credit cheap and abundant across Japan. Banks lent freely against real estate and stock holdings that were themselves rising in value, a feedback loop in which higher asset prices justified still more lending, which in turn pushed those same prices higher again. At the peak of the excess, the grounds of the Imperial Palace in Tokyo were said, by one widely repeated estimate, to be worth more on paper than the entire state of California, a comparison used ever since to illustrate just how far the market had drifted from anything resembling underlying economic reality. The Bank of Japan began tightening policy from 1989 onward to cool the excess, and both stock and real estate prices began a long, grinding decline through the early and middle years of the 1990s that did not fully bottom out in some markets for the better part of a decade. Banks left holding real estate loans worth far more than their now devalued collateral, quietly avoided writing off the losses for years, keeping many of these loans technically alive on paper rather than acknowledging them as lost, a practice that slowed the country's broader recovery considerably. The period since is commonly known as Japan's lost decade, though a number of economists argue it stretched on considerably longer than that name suggests. Ordinary households felt the slow deflation just as much as banks did, since a generation of buyers who had purchased homes near the peak found themselves owing far more than their property was now worth, a burden many carried quietly for years rather than face selling at an open loss. Golf club memberships themselves, once treated as a genuinely liquid investment, became worth only a small fraction of their peak within a few years, a small but telling measure of just how far the entire logic of the bubble had run. The bubble did not burst in a single afternoon. It leaked slowly for the better part of 10 years. A geologist's routine drilling report out of a remote patch of Western Australian outback in September 1969 turned an obscure, barely traded mining company into the most talked about stock on the entire Australian exchange within a matter of weeks. Poseidon NL, a small mining company, announced a promising nickel discovery at a site called Windara, timed amid genuinely strong global nickel prices driven partly by supply disruptions elsewhere in the world. The share price, sitting at just 80 cents in August 1969, climbed steadily and then explosively over the following months as news of the find spread and speculative momentum built on itself, reaching well over $100 by December and peaking near $280 by February of 1970, an increase of several hundred times its starting value in under 6 months. The excitement spilled well beyond Poseidon itself into a wider speculative frenzy across the entire Australian mining sector, with dozens of other small exploration companies, many of them with no real connection to the Windara discovery at all, watching their own share prices rise purely through association with the general nickel enthusiasm sweeping the market. Actual production at Windara, once it finally began some years later, proved far less profitable than the market's peak valuation had implied, hampered by falling nickel prices and higher than expected extraction costs, and the shares fell back sharply over the following 2 years, ruining a great many smaller investors who had bought in near the very top of the frenzy. Regulators and stock exchange officials, alarmed at how disconnected the wider frenzy had become from any actual mineral discovery, tightened disclosure rules for mining companies in the years that followed, changes that shaped how speculative resource stocks were reported to the Australian public for decades afterward. Even the company's own longtime auditors were reportedly startled by how far the share price had detached from anything resembling the underlying value of a single, still unproven mineral deposit. The nickel in the ground turned out to be genuinely real. The price the market briefly paid for it was not. For years, the trading reports arriving in London from Baring's Singapore office showed one of the bank's most talented young traders generating steady, enviable profits, and almost no one senior thought to ask too closely how. Nick Leeson ran Baring's Singapore derivatives desk, and he began hiding mounting trading losses in a secret error account rather than reporting them upward, initially to quietly cover a junior colleague's small mistake before the habit became his own. Rather than close the losing position and accept the loss, Leeson doubled down again and again, trying to trade his own way back to even, a pattern that only compounded what he owed each time the market moved further against him. He held both the trading role and the back-office settlement role that was meant to independently verify his own trades, a basic failure of internal separation between the two functions that made the concealment possible for as long as it lasted. Losses ballooned further after the Kobe earthquake in January 1995 unsettled Asian markets in exactly the direction opposite his largest bets. By late February 1995, the hidden losses had grown to roughly the entire capital base of the 233-year-old bank. Leeson fled Singapore as the truth began to surface, was later arrested in Germany, and extradited back to Singapore to face trial. And Barings, unable to absorb losses of that size, was declared insolvent within days and sold to a Dutch bank for a token sum. The bank's own name, older than the country it operated from, survived only as a brand attached to its new Dutch owner, while regulators around the world cited the collapse for years afterward as the textbook argument for why the person placing a trade should never also be the person checking whether that trade was reported honestly. Leeson later wrote candidly about the collapse from prison, and his account became something close to required reading in business schools for what it revealed about how easily unchecked authority, however junior, can quietly outrun the systems meant to contain it. 233 years of institutional history ended over a single weekend of frantic phone calls. The note itself, printed in 2008, carried more zeros than most people will ever see on a single piece of paper at once. 100 trillion Zimbabwean dollars, and by the time it reached anyone's actual hand, it could barely buy a loaf of bread. Zimbabwe's hyperinflation built up over years from a combination of largely unchecked money printing to cover government deficits, a land reform program that badly disrupted commercial agricultural output, long one of the country's main sources of export earnings, and the costly expense of involvement in a regional war. By 2008, inflation had reached levels that are difficult to state in any way that feels concrete, with commonly cited estimates placing the peak monthly rate somewhere close to 80 billion%. The central bank kept issuing notes carrying more and more zeros, redenominating the currency multiple times, stripping zeros off the currency, only for inflation to reintroduce them within a matter of months each time. Daily life adapted around it in strange, specific ways. Shoppers carried cash in plastic bags rather than wallets or purses, simply because of the sheer bulk of notes required for ordinary purchases. Some shops changed their posted prices between morning and afternoon, and workers grew accustomed to spending their wages within hours of being paid before the money lost still more of its worth. The $100 trillion note, despite its almost unimaginable printed value, was reportedly worth only around $30 on the day it first entered circulation, and considerably less within a matter of weeks before the currency was abandoned altogether in 2009 in favor of foreign currencies. Street vendors near tourist sites in Zimbabwe still sell surviving $100 trillion notes today for a few real dollars apiece. A small, strange afterlife for a piece of paper that once represented, however briefly and however meaninglessly, the largest denomination any government has ever printed. Neighboring countries absorbed a wave of Zimbabwean migrants during these same years, many citing the currency's collapse more than any single other factor as the reason they finally chose to leave. The note still circulates today, not as money, but as a souvenir of what money looks like at the exact moment it stops working. The oldest trick in the history of money is paying old investors with new investors' cash. And in 2008 it still worked, on a scale no one before him had ever quite managed. Bernie Madoff spent decades building a reputation, first as a legitimate and genuinely respected market maker, later as a chairman of the Nasdaq Stock Exchange, credentials that made his separate, more private investment advisory business seem all but beyond ordinary suspicion. That advisory business reported suspiciously steady, moderate returns year after year, largely unaffected by how the wider market actually performed. A consistency that should by rights have invited far more scrutiny than it did, but instead read, to most clients and even a number of sophisticated financial institutions, as a mark of exceptional and enviable skill. A handful of financial analysts, most notably an investigator named Hari Markopoulos, repeatedly flagged the reported returns to regulators as mathematically implausible over nearly a decade of warnings, complaints that were investigated only superficially each time and ultimately set aside. The scheme finally collapsed in December 2008, when the wider financial crisis prompted a wave of client withdrawal requests that far outstripped the flow of new money coming in, precisely the vulnerability that every scheme of this shape eventually meets given enough time. Madoff confessed the fraud to his own sons, who reported him to authorities the next day, and he was later sentenced to 150 years in prison. On paper, the fraud's reported losses ran into the tens of billions of dollars, though a meaningful portion was eventually recovered and returned to victims through a court-appointed process that continued for years afterward. Some of his victims were large, sophisticated institutions that should have known better. Many others were ordinary retirees and charities that had trusted his reputation precisely because it seemed too respectable to question, a detail that made the eventual unraveling feel, to those who followed the case closely, less like a single fraud than a slow-motion collapse of trust, running in several directions at once. Several of his own longtime employees were later convicted for their roles in keeping the fraud's paperwork convincing enough to survive decades of periodic regulatory review. The trick itself was as old as money, only the number at the end of it was new. Money has been doing this since long before anyone thought to write any of it down, and it will keep doing it long after tonight's list is forgotten. Promise outrunning proof, and someone, somewhere, quietly betting the gap will hold a little longer than it actually does. Silver still moves from a mine toward a debt it was never quite enough to cover. A promise still gets written down faster than it can be kept. None of the people in this list thought of themselves in the moment as the fool in someone else's story. They thought, the way most people do, that this time the collateral was solid, the man across the table was exactly who he said he was, the trust was real. Most of the time, they would have been right. Money moves it all, because trust mostly holds, quietly, across countless ordinary exchanges no one will ever bother telling a story about. It is only the rare, sharp exceptions that get remembered this carefully, and told back calmly, years or centuries later, to people who were never at any real risk from any of it. Somewhere tonight, in some small quiet arrangement nobody outside it has heard of yet, that same gap between promise and proof is opening again. It will not introduce itself as a disaster. It never does, not to the people standing closest to it, and it rarely announces itself to anyone else either, until long after the fact, when someone finally goes looking for whatever was supposed to be sitting underneath the promise and doesn't find it. This channel will keep watching for these things, rather than warning anyone away from them, because the watching is the more honest work. What people actually did with money, not what they should have done, told plainly enough that the pattern becomes visible on its own, without anyone here needing to point at it directly. The bulb went back to being a flower. The vault that was empty eventually held something again. The story does not really end. It just, quietly, changes hands.